When investing in the stock market, you generally have the choice to invest in either stocks or bonds. When you buy a stock, you then own a small share in the company that you just invested in. But how exactly do bonds work? Who is it that sells the bonds? How do you make money from the investment? And what returns can you expect? Without wasting any more time, let's get straight into the content and answer these questions. A bond is a fixed income instrument that represents a loan from an investor to a borrower. Bonds are used by companies, municipalities, states and sovereign governments to fund their projects and operations. So, when you purchase a bond, you are basically loaning money to a government or a corporation. Why would you do this? Well, there are two main ways that bonds can make you money. When you purchase a bond, the borrower will pay you interest, which gives you a fixed income. This will often be in the form of annual or semi-annual interest payments from the bond issuer. When the bond has matured, which means that the loan has ended, you will then sell the bond back to the issuer. If the bond is worth more than what it was when you bought it, then you make a profit. However, if the bond is worth less than when you bought it, you will lose money. Bond prices are inversely correlated with interest rates. This means that when interest rates go up, bond prices fall, and when interest rates go down, bond prices increase. There are some key terms that you also need to know when investing in bonds. These are face value. This is the amount that the bond will be worth at maturity, or at the end of a loan. The face value is defined before you purchase the bond, and it is often a round number, like £1,000. Coupon rate. This is a rate of interest that the bond issuer will pay on the face value of the bond. A 4% coupon rate would mean that a bond with a face value of £1,000 would pay £40 in interest each year. Coupon dates. This is quite simply the days that the coupon payments will be made. These dates can be at any interval, but the standard is semi-annually. Maturity date. This is the date in which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. The maturity date can be short term at 1 to 3 years, medium term at around 10 years or longer, or even long term at around 30 years. Finally, issue price. This is the price at which the issuer initially sells the bond. Now that you know what a bond is, let's run through a quick example so you can see how they work. Let's say you invest in a bond that has an issue price of £950 with a maturity date of 5 years. The coupon rate of the bond is 5% and the coupons are paid semi-annually. Finally, the face value of the bond is £1,000. The coupon rate of 5% means that you will earn £50 in interest each year. These are paid semi-annually, so you will actually receive £25 every 6 months. Over the 5 years, you will receive 10 payments of £25, which sums up to £250. When your bond reaches a maturity date, you will sell it back to the issuer at the face value of £1,000. So, your £950 bond purchase resulted in an overall return of £1,250. That's £300 in profit. So, with the basics out of the way, let's get straight into the details of investing in bonds. Bonds are great for adding sources of fixed income to your portfolio. However, this guaranteed income is obviously much less risky than investing in stocks, so the expected returns are inherently lower. Since 1926, stocks have returned around 9 to 10% each year, whilst long-term government bonds have earned about half of that, at 5%, according to Morningstar. Combining both stocks and bonds in a portfolio is a common method for most investors. You will often hear of 80-20 or 60-40 portfolios. This is referring to the percentage of stocks and bonds that make up the portfolio. Adding bonds to your portfolio generally reduces your overall returns, but it provides much smoother results. This means that investors who are more cautious of the stock market tend to increase the percentage of bonds in their portfolio. More risk-tolerant investors tend to ignore bonds and invest in just 100% stocks. It's common practice to increase your allocation to bonds as you get older. This is because the closer to retirement you are, the more detrimental a market crash could be to your portfolio. To reduce the risk of losing large amounts of wealth in your retirement, it could make sense to increase your bond allocation. However, investors do need to remember that some bonds can be risky. For example, some bonds have much higher yields than others. And why is this? The yield of a bond is generally related to the risk that is associated with them. If a bond issuer is less creditworthy, there is a higher risk that they will default on the payments. This could result in you losing the value of your bond and your investment. These higher risk bonds tend to offer a higher yield to reward the investors for taking on the risk. Therefore, you should be careful when selecting which bonds to invest in, as the return from them isn't necessarily guaranteed, just like stocks. And with that, make sure to subscribe to the channel for more stock market related content every week. If you found the video useful, make sure to give it a like and share it with a friend so that they can learn about bonds too. If you want to see me go into more details about specific types of bonds, let me know in the comments. And a final disclaimer, I am not a qualified investment advisor, I'm simply an amateur investor who loves saving and investing. And with that, thanks for watching.